from $90 to 26 cents. That's not a stock chart. That's a crime scene. How did Enron, America's most innovative company, hide $30 billion in debt while reporting $100 billion in revenue? The collapse traces back to one decision, and it's not the one everyone blames. When Enron filed for bankruptcy on December 2, 2001, it was the largest in U.S. history, $63.4 billion in assets gone. Shareholders lost $40 billion, and an 89-year-old accounting firm was destroyed. Enron was born in 1985 from a merger of two natural gas pipelines. The name almost was enteron, a medical term for intestines. Employees quickly vetoed that. In 1989, McKinsey consultant Jeffrey Skilling proposed the gas bank, linking producers and consumers through financial contracts. It turned natural gas into a tradable commodity. Skilling championed mark-to-market accounting. Enron could book projected future profits from long-term contracts as current income, even if the cash hadn't arrived. It was legal, but dangerous. From 1996 to 20, Enron's revenues grew 65% per year, while the rest of the energy industry grew 2–3%. The market believed the story. Enron's stock surged 56% in 1999 and 87% in 20, while the S&P 500 gained 20% and then lost 10%. By August 20, the stock hit $90.75. Enron used the merchant model, reporting the entire value of each trade as revenue. Goldman Sachs used the agent model, reporting only fees. Enron's $100 billion revenue was mostly fake, but the real fraud wasn't in the revenue, it was in the debt. And the decision that made it possible was still 2 years away. In 1998, CFO Andrew Fastow created special-purpose entities, SPIs, named LJM after his wife and 2 sons. These off-balance sheet vehicles would hide Enron's true debt. Fastow's structures were so bewildering that few people could understand them. Enron could borrow billions without reporting it as debt. The balance sheet looked pristine. To meet earnings targets, Enron had Merrill Lynch buy Nigerian barges with a secret buyback guarantee. It was a loan disguised as a sale. Pure fraud. In August 2001, CEO Jeffrey Skilling abruptly resigned after just 6 months. The market was confused, but the real bombshell was about to drop. In October 2001, the Wall Street Journal exposed Fastow's conflict of interest after a former executive leaked an LJM offering memorandum. The house of cards began to crumble. Enron's stock, which had been $83 at the start of 2001, plummeted to less than $1 by November. From $90 to 26 cents, a 99.7% loss. Rival Donaghy offered a fire sale buyout, but it collapsed after Enron's credit rating was downgraded. There was no escape. On December 2, 2001, Enron filed for Chapter 11 bankruptcy with $63.4 billion in assets. It was the largest bankruptcy in U.S. history at the time. Arthur Andersen, Enron's auditor, was found guilty of illegally shredding documents related to the SEC investigation. The firm collapsed, putting 85,000 people out of work. Shareholders filed a $40 billion lawsuit. They eventually recovered $7.2 billion, about 18 cents on the dollar. The scandal directly led to the Sarbanes-Oxley Act of 2002, increasing penalties for fraud and requiring auditor independence. It was the most significant securities reform since the 1930s. The transferable lesson. When a company's growth defies industry logic by a factor of 20, the numbers are probably lying. Enron's 65% growth versus 2–3% was a red flag no one wanted to see. They didn't just cook the books. They burned the whole kitchen. Enron wasn't a failure of accounting. It was a failure of will. The will to ask the obvious question: how can a pipeline company be worth more than Apple?